You know what blows my mind? Every week I watch business owners hand over, let's say 30, 40, 50, beyond even 50 sometimes, of their hard-earned money to a system that is literally in place and tells you how and how not to do that. So let me ask you this. Are you one of those people? And if so, why are you paying the IRS like it's your favorite subscription for a house mortgage? Why are you paying 37% tax on income your family could legally be paying 12% on? It's not a loophole, it's the rules. Until you understand how to shift your income the way the wealthy do, you'll keep playing defense in a game that's designed for your offense. I know I preach this all the time, but it's the truth. Rich people don't cheat the system. They are understanding it and using it. They spread income across their family, their entire family. They put it into their entities, their trusts. And suddenly that same dollar that used to get taxed at 37% is now building generational wealth. So if you're listening to the show, you deserve that same playbook and knowing exactly how to put it into place. Welcome back to Spicy Takes and Tax Breaks. I'm Aubree Denekamp, business owner, tax strategist, and your write-off queen. Today we're talking about one of my favorite wealth-building moves, income shifting. By the end of this episode, you'll know exactly how to move your money into the lowest legal tax bracket, build wealth inside your family, and stop letting Uncle Sam live rent-free in your finances. Let's get into it. Everybody hates to pay taxes. I get it. I am definitely at the top of that list for sure. But the IRS doesn't punish income. It punishes what kind of income you are going to have, and basically where that lands is how you're going to be penalized for it. So if we're putting your income in the correct bucket, you're not going to have this issue. If you're putting this income in the incorrect bucket, you're going to be paying more to Uncle Sam. So if it's $100,000 that hits your personal tax return and you're sitting in a 35% tax bracket, that's $35,000 that's gone. It's due to the IRS. You owe it by April 15th or at your extension deadline if you're taking the penalty. But if that same $100,000 is split in between your business, your spouse, your children, that's legitimate ways to do it, and that money might be taxed at maybe 12%, if not 22%, maybe not even taxed at all, depending on what else we're looking at in the picture. It's not tax evasion at all. It's literally how the code is written. It's strongly incentivized for business owners. Here's a real example that I ran into recently with a client. Single mom running a social media agency out of her home, and she was paying herself $120K as a W-2 and from her S Corp. She was paying 37% combined in federal and state taxes. We added her 16-year-old daughter to payroll who didn't currently have a job, and with the content planning, admin, taking pictures of her mom, helping post them, that was great. That's $12,000 a year she's taking off that. That $12,000 was a business deduction for mom, saying about, let's say, $4,000 in taxes, and completely tax-free income for her daughter because it was under the standard deduction limit, which was $14,600 for 2024, for reference. So that's about $4,400 that they kept inside their household instead of losing it to the IRS by just moving where that income landed. If it's not the definition of smart parenting, I really don't know what is. You should be utilizing this if you're not already. So here's a few things we can do right now. Identify maybe one or two family members who legitimately could help in your business. It could be kids, spouses, parents, a sister even. So the biggest thing that we want to do here is tie every single dollar to pay real work at a market rate, and you want to document it. So that's a job description, time logs, deliverables, pay something on Instagram or your website showing that they actually were part of the photo. Those things are super important. So it's important to look at who qualifies and how that's actually going to work for you. So for me, obviously, as I've said before, kids are my fan favorite. Overall, most people personally like them too. Let's run through the basics of why this is a slam dunk for most people. First and foremost, it is the standard deduction shelter. So a dependent can wipe out federal income tax on wages up to the standard deduction. For perspective, a single standard filer for 2024 was $14,600, and we're looking at $15,750 for 2025. This number typically increases year after year. So the first question I get here is, what does that mean for my kiddo? Do they need to file a tax return? If so, when do they need to do that? Is there a certain age? The short answer here is it depends completely on how we're paying them and what amounts we're paying them. If they earned only W-2 wages and total wages are below that standard deduction and there's no federal income tax that's withheld, they're generally not required to file a federal return. If any federal income tax was withheld, you'll see a box 2 on the W-2, and that's basically where it's going to tell you that number. And filing a simple return is how they get that money back. It's a free refund. You definitely want to claim that, so don't skip it. If, for example, they got a 1099 and they had self-employment income, let's think freelancing, TikTok, brand deals, whatever that looks like, and net profit is more than $400, they must file. The standard deduction does not erase fully self-employment taxes, but remember, we're talking about this is the net profit, not that the revenue received. So think profit after all the expenditures that is tied to whatever that income was for the year. So let's talk investment income in this. So a lot of people miss this. Interest, dividends, stock gains, it's a totally different lane, even when you're talking about kids. So when your child earns money from an investment, it's called unearned income. And the IRS plays by a separate set of rules here. It's typically considered a kiddie tax. Short version is the IRS doesn't want high earning parents shifting investment account income to their kid's name just to dodge their higher tax rate. So we can do this, but we want to make sure we're looking at what the child's unearned income is. And if it's passing just small annual thresholds, about 2,600, I think it was in 24, and we're looking 2,700 in 2025, the excess is taxed at the parent's marginal rate, not the child's at this point. So what does that actually mean? If your teen has been saving, they have a savings account, let's say $150 in interest, or small custodial brokerage interest kicking about $400 in dividends, it's really not a big deal. That's all going to be below that kiddie tax line. So if the threshold is bigger, say your 17-year-old is sitting on about a $30,000 investment account and grandma had inherited to him, it generates about, let's say, $3,500 in dividends. Roughly $800 of that is going to be income that's pulled into your tax rate now, not theirs anymore. So remember, when you're working with a tax strategist or advisor, small starter accounts are fine and can be a great teaching tool. I highly, highly recommend that and definitely utilize that with my own daughter. But when balances grow or when a kiddo's portfolio starts producing more than, I don't know, I'd say a couple $1,000s is income, you'll want to make sure to file a return for the child first and foremost. We don't want to skip that. Evaluate the ownership also. If it makes sense to move these investments into maybe a 529 or cafeteria plan, family trust, maybe parent-owned brokerage instead of a custodial account, we can definitely take a look at that too. Depending on your long-term goals, this might be a better option. But plan the timing of a sale is crucial. Capital gains realized in a child's name can also fall under that kiddie tax rule. So if total unearned income breaks that threshold, we do want to make sure we're planning when we're selling and when we're pulling that money out. So next up here is paying your spouse, often known as your stealth chief operating officer, as I like to say, or a board member. Why does this work so well? So if your spouse handles any sort of communication, admin tasks, light operation, maybe customer service, bookkeeping, sales support, what you're doing is you're paying them, and that moves income into their bracket, and it unlocks benefit planning for you. So retirement contributions, HSA, eligibility through your plan design. Basically what we're trying to do based on where you're at in your age and your current finances. So a quick example of how this kind of would work is, let's say you have net $300,000. Your spouse currently earns $0 in income, but is legitimately doing some part of your scheduling or AP, AR. Add them on as a W-2. Let's call it $40K salary. If you shift $40K out of that higher bracket, your spouse can now defer into a 401K, which is up to $23,525, plus catch-ups if they're eligible, depending on age. You can also add a solo 401K or company plan structure. So you've just moved that taxable income from both your business and from her or him, your spouse, into a tax advantage bucket. Everyone wins here. So an example of when this doesn't work very well, not everyone wins, is paying a spouse who does no actual work. It sounds great, but it's less than thrilling in the midst of an audit. So make sure you're doing some sort of tracking wherever you can to make that legitimate. Another one could be if you already outsource those tasks to a cheaper person and you're not actually saving any money, but having your person take up a lot more expense from the business. If you're not financially at a place to do that, swapping to spouse pay might increase tax and admin costs, but there's not really a gain. So make sure to be looking at that internally as a structure. I know it's annoying, but trust me, I've made a living on it. Documentation is everything. If you are hiring your spouse, if you're hiring your child, if you're hiring your best friend, we want to make sure that we're documenting it in some way. So a formal offer letter would be great documentation, a job description to have on file, something to keep track of timekeeping or how you're paying them. Remember, you're their manager here. So keep track of whatever's going around that you can. Also make sure that you're paying at some sort of market value that makes sense in your area, not paying your child $300,000 to take a photo a year. That's a little bit out of what scope would be if you are audited. So keep that in mind too. Another go-to that I've been having a lot of, especially recently, my age range bracket, a lot of parents, grandparents, in-laws are retiring. So let's jump into what hiring them looks like and why. Outside of bossing your parents around, which is also great, you're also gaining a tax benefit here. So once they're retired, they often are in a lower tax bracket than when they were working, which is perfect. Part-time phones, admin, property oversight, mail drop-off and pickups, deliveries, whatever that looks like. It's a great position, but you're getting the deduction there, and they may pay a little bit, which you can eat up that tax in a bonus if you'd like, or oftentimes no tax, depending on where their bracket is in that standard deduction. I'm going to do my best to keep this kind of simple here. Main numbers you'll hear me mention today are going to be the ones that actually matter when you're paying your family members, and things you want to keep a look at every year because they do change. Setting up benefits is really big too here, so we can play with that based on what cash flow and availability you have to put in is. But standard deduction, this is going to be your zero tax wage room. Basically, this is how much someone can earn before any federal income tax starts. So for 2024, it was $14,600. In 2025, it's $15,750 filing single. So for your child who's a dependent, they can usually earn up to what their standard deduction is and pay zero in federal income tax, as long as that income tax is from a wage for a W-2. To translate out from Nerd Forum, your kid can make roughly 15 grand and still owe zero in federal income tax, and often not even have to file a return. That's the zero tax zone. You want to stay inside this when you're paying your kids, unless you've talked to someone about a deeper strategy. In the next episode, we will go a lot deeper into 401k employee deferrals, which is great for spouse, IRA, Roth IRAs, HSAs, Social Security wage bases, and bonus depreciation caps. But I'll go through kind of right now a quick go or no-go checklist. Here's typically where I say go for paying family members and when it's going to make sense. Work is real, rate is fair, you're documenting it in some form. If you're a sole prop or a parent partnership paying kids under 18, you have no FICA, no FUTA, which is a huge tax savings for both you and them. If your spouse is genuinely part of your business in some sense, even if that is a really great sounding board or a board member, you want to access 401k benefits, health benefits through payroll, absolutely utilize it. Your parents are in a lower tax bracket, extra income won't mess with their Social Security or Medicare premiums, absolutely worth taking a look at. Areas where I kind of say stray away unless you've talked to someone is going to be if you're an escort paying very young child in small amounts, setting up a payroll for them, and those payroll taxes eat up the benefit for you. So it's something we want to make sure we're actually making the correct thresholds for before setting up. Having no time logs, no receipts, no deliverables, I say no. Deduction's not going to hold up. So make sure if you are going to do this, the light documentation you need, I cannot say it enough, do it. If you're paying inflated family rates for fuzzy roles like an emotional support specialist or your hand-holding buddy, I'd say let's beef up those a little bit. Extra income that you could push into someone else, we want to make sure that it's not putting, especially a parent, into a Medicare bracket that's going to put them into a lot higher issue, especially when it comes to taxes down the road. Also, same with education for kids. We want to make sure we're not putting them over any thresholds that would limit them from them getting that help down the road. So make sure to keep it real, keep it documented, be strategic with it. But family payroll, if it's done right, it's great. It builds wealth right inside your house, saves you money off the top, and not giving it to Uncle Sam. There's so many ways to plan this, though, based on your situation. I want to zoom back for a minute. The real power play is not just paying your family. It's being intentional with shifting income, however you're doing that. So give examples in real life for you to kind of think about. Emily, we'll call her, is a client of mine. She owned a landscaping company making about $350K net a year. She was paying all under her name. Her husband decided to work part-time and was staying home with the kids a lot more. He was in a 12% bracket by himself if they were to be filing separately. So by restructuring her LLC and creating an LLC to him, we were able to mitigate almost all of that liability without putting him in a higher bracket as well. So it shifted over $55,000 of income from her 35% tax bracket. It brought her down to the 22% tax bracket. We can do this in a lot of different ways and even increase that more, but for them that made sense. It's a tax savings of about roughly $16,000 that year. Same household, same amount of money sent, less IRS though. So this is the key. If you don't have additional money to be putting into different planning or opening up all these retirements, you can a lot of times use the money you're already using throughout the year and actually be shifting that into a lower tax bracket, but still spending on the same things. Something you want to be thinking about. So next one's going to be the entity shift. This one gets a little bit sexy. It's where the real money starts moving. Wealthy don't just shift income between people. They're shifting it between their entities. Think of each entity like a different container or bowl. Some are taxed at a higher rate, some lower. Some get deductions, others don't. Well, if you dump all your income into one container, you're doing what 90% of business owners do, and you're losing 5 to 6 figures most of the time once that income gets higher because of it. Let's run through a few examples of how this is going to work. So we'll call this the management company. Let's say you have an S Corp and your main business, let's call it a accounting firm. That's going to be your management company. You create a C Corp management company for this that handles all the marketing, admin, payroll. Your S Corp is going to pay your C Corp a management fee every month, and every year you're going to file as a C Corp. Now, part of your income is taxed at that 21% corporate rate instead of your personal rate, which is really, really great. Your C Corp can offer extra benefits like health reimbursement plans, 401ks, fringe benefits. We can do perks like gym memberships, travel reimbursements. Legal, 100%. You just need a legit service and fair market fees. But basically what you're doing is you're gaining all of the benefits of being an S Corp while still having some of your income shifted to that 21% limit for the C Corp. Okay, let me think about it. Another example of how this work would be shifting for real estate for income. Do you own your office space or do you rent it? If so, you create an LLC that holds that property if you own it. Your business now is paying rent to your LLC that has the property. Your business is getting a deduction, your LLC is earning passive income, and you're shifting money into different tax brackets so they're taxed differently, a lot of times at a much lower rate. We want to make sure that you're using a fair rent, so take a look at what you would rent something else or what you'd be able to rent it for yourself. Create a lease so you have a written lease between the new LLC as well as the business that's renting it, and actually transfer that money monthly. So make sure to have the income coming into the LLC from that S Corp or whatever business you're renting from. Don't just send zero and make it up at the end of the year. The IRS does check that. And so if you're audited, that is something that they will be looking at. Remember, the key to this game is intentional separation from what you're doing. It's not hiding income, but placing it in the most efficient lane. Think of it like freeway traffic. Personal income, heavy traffic, high tolls, a lot of accidents. Entity income, express lane with a big discount. Get there quicker. So guardrails and kind of things to keep in mind as we're doing it. Income shifting is 100% legal, but it has to have substance and a reason. Often I see as far as rookie mistakes is going to be paying your 6-year-old $150K for modeling on your website with one single photo annually. Not a great idea. Make sure there's a little bit more behind that, or at least have it really well documented for if they do knock on your door. Let's say you list your partner as the VP of sales and they've done nothing to work for the company and not one person in your organization knows who they are. It's probably not a great idea. If you're renting your home, which you should be renting your home to your business, don't make it $100,000 a year when market rate is probably 16 or 13. These things can get you flagged, and I want to make sure that we're doing it correctly because they're there for you to do, not incorrectly. Even if they don't immediately knock on your door for an audit too, because that's another pushback I get is, hey, I've done this for years though and I haven't been audited. Let's rework what we're doing, because when they do come knocking, we don't want to just make it completely an audit mess, I guess we'll call it in nice terms. It's really not that hard to document it though once you know how to do it. Always just be sure to have documentation, whether that's job descriptions, invoices, a lease agreement, transfers to your family members, not just a note saying you'll pay them. This is great. Make sure hire a good bookkeeper to handle all of this for you if you don't know how to do it yourself. It can save you so much time, so much money, and such a headache down the line. So make sure, for goodness sake, use a legit payroll company too. I have a lot of people who try to do payroll taxes themselves, and I do not recommend that. That is not something you want to mess up with. So there's millions of options, and great ones at that. So you don't want to be in a mess of penalties or liabilities from trying to do it yourself. So keep that in mind also. Payroll is not something you want to mess with. The IRS has a doctrine called an assignment of income. It basically says you can't just hand off income to someone else on paper. There really has to be ownership and work performed, money received. When you follow those rules, you're bulletproof. We're going to skim through kind of some compounding wealth things while we're on this, just so we get through the whole deep dive. If you're not already doing it, please start now. It's the real thing. Every dollar you shift to a lower tax bracket is not just a tax saving, it's seed money for your next investment, for your next business, for your next rainy day fund project. If you save 10K this year, invest that 10K in your solo 401k, a brokerage account, your kid's Roth IRA. At 8% return, that's over 50K in 10 years just by doing that 10K savings this year. Do that for every year or a decade. You've built six-figure wealth just by doing what you would have been paying to the IRS from taxes previously. It's crazy to me. But bonus points for anyone working with a strategist who takes the liability saved to invest for you. It's truly going to be a game changer if you're trying to build wealth or build a retirement or know what's next. Your everyday savings or lifestyle is not impacted because this was money that was going to be going to the IRS anyways. You make your tax savings into your next investment. It's brilliant. Here's the truth. Income shifting is not a trick. Framework. Once you understand how the tax code actually works, you stop saying, can I write this off? And start asking, hey, how am I going to structure this for my life today? And how am I going to keep changing the structure for 5 years from now? There's no single magic deduction. There are so many layers, so many strategies that can be deployed, and all of this depends on where you're at and where you're trying to go. Every person's situation is different. Every family, every business model. It creates a new version of the game though. So you can do this and pair your income shifting with your travel deductions, mix your payroll with retirement plans, stack real estate depreciation with trust structures. There's so many things. So what we want to do is make sure that you have these millions of legal combinations working for you. That's what makes tax strategy so powerful. It's not one rule, it's the art of how you use all of the rules together. Again, wealthy do not have a secret code. They just know how to combine the rules that already exist for their benefit. So as you're listening here today, I want you to start thinking like that. What can I layer next? What can I move? What areas can I grow? Can I realign anything? Because every move that keeps a dollar in your circle or your pocket, it moves to build you more wealth. It's not just income, but can also build you more of it. Remember, you don't have to be rich to play this game. You just have to stop doing taxes reactively and start structuring proactively. Again, I'm Aubree Denekamp, your write-off queen, and this has been Spicy Takes and Tax Breaks. Until next time, shift smart, stack strategies, and live wealthy. This is a game-changing thing, and I'm excited for you to keep going.